everyone wanted to get out of their own space. So you had a lot of, roommates splitting, need to get new rooms, or people wanted to go buy their house and have more space. All of that compounded to create a jump in demand and a reduction in the cost of debt. Now that we've seen costs of capital, interest rate increase, it's just frozen the market. And I think we're going to start having that thaw as the Fed adjusts the rates, but it's just really, I think, just once in a generation market dynamic that created this really very weird situation.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Ladies and gentlemen, my next guest is a seasoned professional with over a decade of expertise in real estate investment, specializing in multifamily assets. Through his career, he has played an instrumental role in managing a diverse investment portfolio exceeding $165 million in asset value, raising investor capital, and minimizing investment risk. Prior to his venture in real estate, he served as a CFO, chief financial officer in both legal and tech sectors, honing his financial acumen and strategic leadership skills, a keen eye for identifying lucrative opportunities, and a proven track record of successful investments. Casey, welcome to the show, man. I'm super stoked to have you here, based in Washington, Tri-Cities. I was in Seattle here before moving to Austin, and it's just so funny that we know a number of the same people too as it goes. So pumped to have you here, man. For those listening and just starting to get to know you, tell us a little bit of how you got into real estate itself. Some of the points of that. Yeah, just get into it. I'm excited here, guys.
Yeah,
So
yeah,
tell us a little bit how you got into real estate.
absolutely. Well, hey, first of all, thanks for having me on the podcast. It was great connecting with you. And yeah, it's a small world out there, and we got a lot of common friends and connections. So yeah, my journey into real estate really started about 10 years ago. I graduated into the Great Recession, 2011, going in, got my first job, but they had some downsizing, and I'd felt like I'd gone through the correct playbook of going through studying engineering and then business, doing what everyone says to be successful. And I had a period of 6 months of unemployment. It was really difficult. I think unemployment was at 15%. And it was really a difficult time emotionally for me. And so when I got my next job, I really wanted to say, how do I not get myself in that position again? And through some research, I found the FIRE movement, the financial independence, retire early. And through that research, I really geeked out a lot on investing and found real estate. I was already living in my first house that was a live-in fix and flip. Didn't know anything that I was doing, but I saw that, hey, we can have a tangible asset that we can increase the value on. And so I talked to my wife about selling the house and buying a couple duplexes. She was pregnant with my first son. And like, well, let's just buy a duplex. We can live in half. And if we don't like it, we'll, buy our next house. And she was like, okay, I'll support you on that. And, not only did I find one duplex, we're under contract, but I found a better duplex that was in a nicer neighborhood. So I was like, can we buy both of these? And she's like, well, do you know what you're doing? I'm like, yeah, I know what I'm doing. Let's go. And I was so scared. I mean, so God bless her for supporting me on that. But I wanted to make those investments such a success that I wanted to save money by doing everything myself. I property managed. I was going in. I was fixing things that needed fixing. And I did that for about 2 years until I had a huge meltdown of my tenants were, just walk. I don't have the personality to be really stern and, that kind of person. And so I was getting walked over a little bit. I was being very nice on, I'll accept some late rent, doing all the rookie mistakes. And I got introduced to a great property management company and let them kind of take that off my hands. And I saw just how poorly of a job I was doing by contrast to seeing how great they were doing. That it's like, well, this is stupid. Why don't I focus and double down on what I'm really good at and try and build out partnerships that fill my weaknesses, and we can create a team that grows together. So that was the start of our real estate journey.
I love it. So, first thing that stood out to me was I love how I don't know if this timeline, so I'll ask: was it that you're unemployed for those 6 months and you're thinking about how do I retire early? Was that what you're thinking
No, it was mostly 6 months of, still fixing up the house. So I'm laying floor and I'm applying to jobs, I'm painting. And then I was like, all right, how behind am I? You know,
I
6
got
months, it's a quick time, but then I started doing the research and I found, oh, why don't I really focus on actually building out investments that create passive income or at least some stability. I didn't know what I would do once I got to my fire number, but I knew that I it was a worthy goal of exploring.
totally. I'm thinking like quite the visionary. I don't have a job here. I have a fixed employment and I got a baby on the way. But you know what? Let's learn about financial independence retiring early.
So,
So I mean,
founded or unfounded confidence.
yeah. No, I love it. I love it. So the two different duplexes there and kind of doing everything on your own. Was this where did you get the idea to even go for the duplexes?
So I came across some blogs on Reddit, got introduced to the Bigger Pockets community, and was learning about small multifamily. I bought some books about cash flow and how to underwrite properties, and I remember sitting with my Excel sheet trying to figure out what an APOD is, annual property operating data. I'm like, okay, well, it's a duplex. I can figure out the rents, right? What's the market rent times two? Okay, great. But then I'm like, well, how much for insurance? How much for property taxes? So like, where do I go for all this information? And it was really just trying to stumble through it, be conservative. But at that time, we were exceeding the 1% rule. I could, kind of screw it up and still get 8% cash on cash. So it was a really safe environment for it.
Cool. That's awesome. Many people are listening, and these are questions I get quite a few times as well, talking to investors and colleagues in the tech space. They're looking at, okay, they've probably bought their primary residence at this point. They've
Mm-hmm.
got, the cars, they can take the trips, that kind of stuff. Life is pretty good, but how do I get more, income, right? And so the idea of, well, should I buy a duplex? Should I buy a quadplex? Like, can I, buy something else other than just a single family home? Because they're trying to reduce risk as well. And, they may not also have the skills or want to go and answer the 3 a.m. calls, or whatever that is kind of needed to take care of the care and feeding of residents in one of these smaller properties. Talk to me a little more about just sort of a quick analysis, pros and cons of having gone through the steps here of getting the duplex, getting the quadplex, or I think you said, I think, did you say an eight as well? Eightplex.
I started off on the two plexes. Yeah, I've bought four plexes, eight plexes, all that
Got it.
since then. Yeah.
So, who's the right person to even go and buy a duplex or a quadplex? Do you have any thoughts and pros and cons for who that's kind of right for? And I guess as a follow on, is that you think that's right for someone who's an accredited investor who's making two, three, 400 grand or so?
hmm Yeah, I'd say if I was counseling someone, I'd step back and say, what are your goals on that investment? Because in real estate, you make money really in four ways, but the main ones are obviously cash flow, and then what's your appreciation on your equity. And those have two different strategies for investment. What we focus on now is we buy larger multifamily apartments that are being mismanaged. So we can go in and we can improve the units, put some money into capital expenditures, address deferred maintenance, and get rents up, which then boosts the equity value of that asset. That is a very hands-on, time-intensive, and professional type of investment that I would not recommend to a beginner in there. With that, we're also able to boost cash flows over time. Right now, in the market that we're seeing, because small multifamilies become more competitive in this space, prices have gotten bid up and interest rates are higher to the point where trying to buy cash flow on traditional 75% leverage amounts really isn't feasible. But I would say that if you're patient and you want to build up a portfolio where you can maybe break even or have a little bit, 5% cash on cash, buying that, duplex to fourplex, knowing that in 5, 10 years, both that equities are going to organically appreciate, but still will rent so that you can actually generate some reasonable cash flow on that.
Makes sense. Key points there, kind of where rates are, what you can leverage, right? How much debt you can get on an asset. People
Mm.
listing single family homes used to hearing the 80, 90, however much you can borrow against the asset. So just to clarify on leverage. Um, so it's someone that is willing to put in the time, basically.
Yes.
Yeah.
Yes. Well, if you want to be active in your own investment, yeah, it's obviously going to take a bit of time in there. Obviously, have good partners, good property management that has good connections with themselves with repair companies and subcontractors.
Got
But
it.
it's going to
For
be yeah, it's maybe more of a time investment than doing more of a passive type strategy with the syndication.
Was that an aha moment for you about the getting introduced to a good property manager and how much they can really help?
Oh yeah, it was a lifesaver. I mean, I look back 6 months later and was just like, how boneheaded was I that I didn't think about this a year sooner? I mean, it's you don't. It's hard to see something, the truth when you're in the weeds. Something that takes a retrospective look.
Yeah. Plus, one of the good things about that too is you let the people that really know those types of assets do what they do. And I think one of the things I know you're passionate about too is making sure that you're kind of really clear about what your skills are and what you what you like doing and what you're good at too, right?
Absolutely.
Talk to me a little bit about that. One of the things you mentioned is you even when you're going for asking about going to collect rents that were late or this or that, like it wasn't the thing that you really enjoyed doing. Yes, it's part of the job, and yes, you can hand over different things to property manager. Skills develop over time as you become more business savvy and real estate savvy as well. It's just the nature of the business. You're providing a service, they give it to you. But more to the point, is talk to me a little bit about how you think about collaborating with others now, with partners, and how you kind of went about understanding what your own strengths and likes were and how you build a
hmm
team around you.
Yeah. Well, I think I'd start off with, even though I should not be in the property management role, I am happy that I went through that experience and I fully appreciate what the property managers do. I see a lot of people, novice investors, who look at paying 10% of their rental income and saying, well, there's collecting checks and this and that. And it's like, if that's how you feel about it, why don't you go try and do that job and then see if you think it's worth it. When I look at my skill sets, finance and networking have always gone hand in hand very naturally to me. And when I look at what are my goals on scaling my business, doubling down on things that I'm naturally inclined to, but also make sure that I'm focusing on skills that are that high value tasks, right? What do they say? Like $1 million businesses aren't built on $10 tasks at a time. And so me going collecting rents or trying to get a contractor in, that's really actually devaluing, and the opportunity cost of my time on that is very high. More recently, we're working on getting more of a online presence and make sure that we're communicating effectively what we're doing to a broader audience. And again, I had to get, kind of kicked in the butt again, because I was thinking, well, I need to be doing all this. I got to figure it out before I delegate it. And, we're part of this mastermind group called Raise Masters. And a huge part of that is having a peer network where we can bounce ideas off each other. And, I was in this group talking about this, and there's like 2/3 of them like, well, we got virtual assistants. Why are you doing this? And so I was like, you know what? That's why am I doing that? That's a really stupid way to go about it. And so this past month, again, I've been delegating tasks that are the $10 tasks and focusing on the high level stuff.
I love that because not only is that just such a good testament to peer group, making it so obvious in the way that you should go, and it's these sort of the 2 millimeter shifts, just a little bit, that really makes the difference. You talk about fire as an example, financial. We'll just take the financial independence thing about that. One of the books and coaches that's really big in our spaces too is Dan Sullivan. I'm like Dan Kennedy's the marketing guy, but Dan Sullivan, and it's not just financial independence, but more freedom of time too, right?
Right.
And that's massive for those professionals that are already really busy. For everyone, they want more time, and so if you can outsource $10 an hour tasks, I mean, what is your quote unquote time worth financial, let alone the opportunity cost to go spend that hour with your family or your kids instead, right?
Yeah. Well, the family and kids is a huge part, but I think one of the big ahas for me was, I like to look at opportunities from a not expected value perspective, but from a asymmetric risk perspective. So what I mean by that is, like, if you are going to go to a networking event or try and travel to a conference or something, a lot of people look at it, what's the expected value of that? Okay, well, it's going to cost me, $5,000 to go do this. Maybe I'll get, a probabilistic expected value of 10,000, right? So, okay, maybe I do it, maybe I don't. But when you look at it from a asymmetric risk standpoint, what is the worst thing that happens if I spend that $5,000 and go and do that? I'm out 5 grand. I'm out my time, right? But what's the upside of that? Well, you might meet someone who completely changes your business. You might learn something that changes your business completely. That might be a $500 million trip you make, right? And so having the perspective of asymmetric risk and trying to drive your decision making off of it, I think has been very influential for me. But you can't really do that if you're also bogged down in the $10 tasks, right? If you're sitting here like, okay, I really want to go to that conference, but I need to get this unit turned. We got to get contractors through it. I got to collect rents. I got to do some bookkeeping. I got to make some blog posts. Like you get so inundated in the day to day that you don't free yourself up for those larger opportunities. So that's been key.
100%. I had to learn that one hard times and over time, many time.
Mm.
I've got it now, but you hear the pain in my voice on that one?
I think it's a lesson I got to keep relearning. You know, it can be a hard one.
Yeah. Uh, I'm sort of losing. I had a question for you as a follow up on that. Um, that's a good point. So, talk to me about, we went in and got the initial small multifamily, and you were looking at bigger pockets. You're looking at, different resources to go bigger, right? As you're talking about risk here, uh, it's also, I think we just have to baseline that everything has risk, right?
Hmm. Yep.
um, and that you give a great mental model about asymmetric list. If I don't, then I might lose the 1,000, 2,000 bucks or whatever for this conference. But the upside is if I put in the additional energy to meet with a bunch of people, I know my outcomes before I go, and I take action with that. What is that really worth? How do you get the maximum ROI for your time there too, right?
Hmm.
Outside of the opportunity cost of doing these quote unquote lower value skills. But how did you go from, was it a how did you go from those smaller multifamily to much bigger deals that you're doing now today?
Yeah. Well, first, I wanted to kind of learn and cut my teeth on my own dollar. And so getting my foot in the door with the smaller multifamily and then kind of growing that was that first phase. I'd been in my CFO role with one of my business partners. We had a uh, boutique angel fund where we'd raise capital into that and then go and find entrepreneurs who had startup ideas. And we also had a software company where we would fund with that angel fund at cost development to get to a minimum viable product. And so that was kind of my first experience in raising money. And I'd been investing, my own stuff. I was investing in some commercial real estate, retail, office space with some buddies. And I thought, well, let's pair these two together. What if we raise capital and really scale up? Because it takes just as much effort to buy a 10 unit as a 50 unit or a 100 unit. And you get much more economies of scale, you get more control, and you get out of the price points where you're competing with maybe more amateur people or people who will accept a lower ROI. And so prices get bid up when you're, sub $1 million. We start getting into the multi-million up to, 10. It's a great space to be in. So I started that journey back in 2020 and have been scaling that since.
Super cool. I think you make a really good point there, which, I mean, you can see all over the place too, right? Of as you go higher in numbers, there's less competition, and
Mm-hmm.
the kind of the cognitive dissonance thing is like there's less competition, but it's not actually that much more work. There's economies of scale. It's just knowing that that's a possibility, right?
Mm-hmm.
So it's more just the awareness of it. And
Yeah.
so I'm really curious here. What did you what was the wife thinking as you were going on this journey?
Well, I had left. So after, the 2012 period, I was working another W-2 job and was really like, hey, I'm an entrepreneur. So at that point in 2016, I talked to my wife about leaving that W-2 to go start scaling like this software company and the angel fund. And she was, she saw that I was pretty miserable in my corporate job and hey, go chase things. And so it was really just kind of one after another over years and years. Hey, I got this idea. We talk about it. I remember when I was thinking about going starting the fund. My wife and I were on vacation up at Suncadia. It's a golf course community,
Hmm.
and it was in January, and we had 2 feet of snow, so we went for a walk and we talked about it, and uh, that's when we decided to pull the trigger on getting into multifamily real estate. So she's always been very supportive of my decisions and inclinations there.
That's cool. It sounds like she knew what she was getting into with you, huh?
Yeah.
uh, that's awesome. I mean, having supportive people is so important in life, as we know. But just kind of double clicking on that too, as you continue to do more and more and more. So, you know, coming out of a soft job market, getting into some of the smaller, your real estate, going on that journey, learning lessons about the things that you like, you're good at, meeting property managers that can help to take things over and kind of getting those skills along the way, seeing, hey, it does take a lot of time. Here's how we can offload some of this. And while you focus on higher value activities for you too, you talk about your finance skills, you talk about your networking skills. I want to talk about markets in a second here because this is
Mhm.
usually on people's minds. Like, is it a good time? Things are going crazy with, jobs, things are going crazy with, politics and this and that and the other, right? Which I don't want to talk about, but just, outside noises and factors,
Mhm.
relevant, but, there's places to focus on. And before I get into that, talk to me about the high value skills that you think about for yourself. You talk about finance and you talk about networking. This might be silly for you, so just bear with me on this, but just
Sure.
break this down a little bit. When you talk about the skill of finance, what are some of the things that someone should get that you're seeing that you're good at, so other people can think about? Cool. These are the skills that he has that's making him successful that he thinks about as high value. What could I shoot for learning as well if I don't have
Mhm. Yeah, I would keep it pretty simple. I don't think you need to be getting an MBA in finance to really be effective in this space. I would read a book on how to underwrite and how to understand how property profitability works, how net operating income works, cap rates. These are really the fundamental. You got to understand this. Take a finance 101 course on, they got these online learning platforms, specifically focusing on how do I understand time value of money, net present value, cash on cash, and internal rate of return. If you can get those concepts dialed in, that's all you need to know on the finance side. I would also say that you've got to understand accounting. People think it's so boring, but you can't. I think Buffett says it's the language of business. And if you don't understand what an income statement, balance sheet, and cash flow statement are, you can't properly assess how a property is currently performing and how you want it to perform. So that there's a lot that I just said in there, but it's really if you can get a 101 or a 201 education on that, you don't need to go further on that.
Awesome. Knowing the different, statements of cash flows, balance sheets, etc., and understanding those finance parts. I don't have episodes on there on those yet, but I will
Uh-huh.
definitely make them. I took the notes. I'm like, I should probably do that.
As an aside, so I hired my virtual assistant who knows way more than I do about SEO and digital marketing and all hooks and all that stuff. But the
Yeah,
first thing I did was, okay, we're going to go through. I want you to understand the business. So I gave him a crash course on finance, accounting, how we
nice.
do, all that. I just think it's so imperative if you're in the industry, you just get a rudimentary knowledge of it at least.
Yeah, 100%. And then the more reps you get into it, the more things you look at, the more people you talk to, you're just going to start hearing the language and like, oh yeah, I should know accounting. That is the language of business.
Mm-hmm.
So,
Exactly.
and then this again, how do you, many people listening haven't even really talked to anyone who's an operator, right? I mean, these words of being an operator, a capital raiser, asset manager, whatever,
Mm-hmm.
it's not thrown around a lot in the tech space. It is in finance jobs, et cetera, but not a lot in general tech for the
Mm-hmm.
architects, the engineers, et cetera, et cetera. So you know, share some tips if you could around how you think about networking, how you know what are some of the things you do to meet people? And I don't mean like just go to conference. Do you have things in mind when you go? Do you spend any time to think about what are you trying to get to, help with your asymmetric returns of going there and meeting the people, things
Yeah.
like that, which might seem obvious to you again, but I want to kind of pull the thread on that for you.
Yeah. No, I think it's one of those things that I do enough where I'm kind of a little unconscious about it.
Yeah.
Um, a lot of people, especially younger people, have a bit of a adverse feeling about networking because they feel like it's kind of like, oh, I'm out there like using people, or it's kind of salesy. So my main thing is, give before you get. See how you can help other people. And the best time to meet other people and get to know them is when you're not trying to ask them for something. So whether it's I'm trying to raise money from someone, I mean, how skeezy is it to like be on a golf round and you're like, oh, this guy's like a multi millionaire, and you're like, hey, I got this opportunity. It's not going to work. You're going to turn them off. It's gross. It's slimy. So it's more about how do you help people? How do you listen to what they're trying to go through? And I think it's just as simple as that, having a giving attitude. Um, there are maybe more like strategies where if you're going to go to a conference, you try and research the backgrounds of maybe some keynote speakers or some other attendees if you can get that information and try and figure out who would be fun to connect with. But I think it's more about the mentality during networking than actually anything technical.
Perfect. Yeah, the give, it's the Ziegler, right? If you help enough people get what they want, you get what you want, kind of thing.
Hmm.
And I think doing the rep so that you become someone who wants to provide value versus someone who wants to be transactional is so
Yeah.
key.
Well, it's just
And
life's more fun when you're helping people out and everyone's winning. That's a big sandbox to play in.
totally. And to go from someone who is, you know, kind of getting graded on their own merit to contribute to like a company or something, to really be more collaborative. Like it's one thing to be on teams and work with people. It's another to be like, oh no, Casey, you are awesome at that. Let me take this part, and
Hmm.
like being cool. Like, yeah, we actually are contributing to the same thing. Not like this is my piece of work, that's your piece of work. We're on a team and we do a thing. But like really, it's like being dialed in a lot more because you're much more of a team versus just saying you're part of a team, right?
Hmm.
So,
Absolutely.
talk to me about markets. You again, just going back to that kind of as an anchor that you came out, graduation for the sort of the softer job market, and you're getting into real estate here. Kind of fast forward too, as you've seen things. Give me your take on markets going up and down. Where are we based on the signals you've seen about as a market, et cetera? And I know no one has a crystal ball, but you've got indicators, you've got logic and things around that. So what's your take?
Yeah. Well, I think I'll start with kind of the back, the past 15 years, right? I mean, let's be clear, markets do go down, they go up, they fluctuate. And so you want to not speculate, but also be informed with what's going on. I was fortunate enough to sit out the Great Recession crash. I was in undergrad during the 06, 08 run up. So I didn't experience that directly, but I started getting the real estate market in 2012 with my first house, and I just needed a place to live, so it's a pretty easy decision. But then investing, we started to have this run up in price after the 08 crash, and by 2013, especially in the Seattle market, things were going quite well. And even back then, people were like, "There's going to be a crash. Wait out the crash. This is not a rational run up." And it's like, okay, I don't know. Just going to keep moving and hold these assets for a long time. I think over a long time it's going to go up. But even in 2014, there was doomsayers, right? And then I was investing all through the late teens, and then we got into the 2020 pandemic, and the market got a little confused with the pandemic, but then with the cheap debt, and we were seeing 3.5% cap rates. We're seeing debt at 3%, and everyone was euphoric. And this the old adage about be scared when people are greedy and be greedy when people are scared. But
Yeah.
I'm it's hard to do that. And when you're seeing cap rate compression, prices are going up, rents are going up, everyone wants to get in there. But then we did see, I think it was about a 30% expansion in cap rates. So values did drop. That was offset by the rents increased. And so the actual purchase price kind of flatlined, but the value of an NOI income stream definitely dropped quite a bit. Because if you're going to be buying at a 5 cap rate, but you're paying 7% interest, it doesn't make sense, right? We've seen market fluctuations in there. We're in a really unique time right now where sellers are starting to come back and accept, lower prices for their properties. But we're also in the point where we just had this week the 50 basis point rate cut by the Fed. So when I look at where is the market, where do I think it's going to go over the next, 5, 10 years, I'm pretty bullish on a couple fronts. One is that I think that we're going to be returning back to the natural interest rate of the Fed setting it around 3.5, maybe 4%. Right now, I think he just dipped it down to 4.75. So we got maybe another percentage and a half to go, and that's going to be very beneficial to asset values. That's on the finance side. More on the just fundamental structural side, we have this like endemic shortage of housing stock from single family to multifamily units. We did see a lot of new supply come online from the construction during that cheap debt period in 2020 to 2023. And that supply has come online. Pretty much no new supply is coming online right now. We're at the tail end of that. And the market has done a good job of absorbing that flood of new apartment stock. I think I heard a figure where we brought on more housing since any time since 1970s, but that's really been hurt with the rise in interest rates. So if we're looking at 3 million or so housing units short, and construction costs are up, near term supply is non-existent, I think that's just gonna be bullish for these assets. I think we'll see some we don't underwrite with rent increasing more than 3%, but I think that there's some upside on that. So if you can get a pro forma to work out with two things, if you can have conservative rental increase assumptions and then not be aggressive on your exit cap rates, and you can make that pencil, you got two areas of great upside, and that's why we're bullish.
A lot of good nuggets. I want to pick on this one a little bit,
Mm-hmm.
which is around interest rates. Just a quick recap: interest rates at a certain place coming down, housing shortage itself, right? So that is a function of really supply and demand in the market, which helps, costs, obviously, basic sort of economics there, construction costs as well, so that no new as a driver for not a lot that can come back into, for people to live in, like, just call it what it is. And then conservative pro formas with, lower projected rental increases, and forget the other one you mentioned, but just
Exit
having more
exit cap rates.
exit cap rates.
Yep.
Yeah, on the exit, not think it's going to be too much higher. So let's sort of, I want to double click on the housing shortage aspect. I was kind of, I'll call it ignorant of this for a little bit. Like, I'd heard it a bunch,
Mm-hmm.
but I really kind of want this to soak in for the listener here about, is this, like, what are we talking about here, and how does that actually affect the housing market? There's a lack of, units coming online. We're talking specifically like multifamily. We're talking about apartments that are coming
Mm-hmm.
online, right?
Mm-hmm. Yeah.
And so, if that's true, then that means there's less places to live, which means that there's potentially rising costs.
Yeah, well, I think it's just fundamental supply and demand. We haven't seen a reduction in supply. We've just seen an increase in demand. We've seen the millennials, which is the largest population, enter their peak household formation and house purchasing years in their early to mid 30s. And with not having new supply coming online, that's obviously created a shortage in there where it puts pressure across the entire housing spectrum, whether you're trying to buy a single family house, you're trying to rent an apartment or rent a house, rents have gone up. And that increase in rental income has also then pushed the price of apartments up as well. And so across the board, there's no sector from single family or multifamily or rents that's not getting impacted by that shortage. And really the only solution is to build more houses. The issue is that costs have gone up for materials, for labor, There's a lot of NIMBYism, um, and the cost of permit in a lot of municipalities has gone up. I've heard figures where it costs tens of thousands just to put a shovel on the ground, and all of that compounds to we can't build affordable housing very well because you got to amortize all those costs over a larger housing product to make it a pencil.
Awesome. So just making that super crystal clear for the people listening, it's just that for all of residential, for homes and for apartments, if there's not as many homes being built, then that means that those prices are going to be higher for those houses as well, right? There's as an example, and even for houses that get rented, if those go higher, that competes with apartment units as well, and so
Hmm.
that raises apartments pricing for apartments for on the rental market as well. And the drivers are things like construction costs, like financing and skilled labor, et cetera. So that's how it becomes tangible when you're driving around, you're thinking about, oh, why did that price, that house go for so high? Like we know at face value is because, well, there's a lot of competition, people are bidding a lot, and this
Hmm.
is why. So thanks for going on that journey there with me.
If I could expand on that too, I mean, what we really saw the explosion in prices was when the pandemic hit, and we had two things happen: extremely cheap debt, almost free money, so people could afford way more of a purchase price with the same monthly payment, and then everyone wanted to get out of their own space. So you had a lot of roommates splitting, need to get new rooms, or people wanted to go buy their house and have more space. All of that compounded to create a jump in demand and a reduction in the cost of debt. Um, Now that we've seen costs of capital, the interest rate increase, it's just frozen the market. And I think we're going to start having that thaw as the Fed adjusts the rates, but it's just really, I think, just once in a generation market dynamic that created this really very weird situation.
Yeah, kind of wild, right? It's the perfect storm in different ways to look at it.
Right.
Yeah. Awesome, man. So talk to me a little bit about where you guys are right now. I know you're under contract for like 102 units, right?
Yeah, we're looking to pick up, generally about 3 apartments a year. We're trying to scale rather than grow. So we're not looking to just grow for growth's sake, but to find the right properties in the right markets that fit our investment thesis and that we can really get, leverage our expertise in those markets. In the goal of keeping with 3 apartments a year, we're looking at going larger properties
Mhm.
with the idea that then we can almost have the same amount of time invested, but scale that way. So yeah, we got 102 units in Pullman right now. It's a excellent value add opportunity. The owner was out of state, and there was some water damage when we had a deep freeze last winter. So there's a lot of upside in putting in some hard work and a lot of money invested in turning these units.
Mhm.
We've pretty much raised about all the capital, but we got a few spots left on the cap table, and we're always doing more projects. And so we're always looking to get our name out there and share what we're doing.
Absolutely. And I look forward to more and more from you guys. I see you're doing a bunch of stuff on LinkedIn now too, bigger web presence, etc. Hopefully this podcast get that distributed for more people to get to know you and hear about you. Tell me a little bit about why Pullman is an interesting market and good market for you and the team.
Yeah, it's been a combination of one, we found really good deal flow in there. But it's so for those who don't know, Pullman is a college town that's home to Washington State University. It's the second largest university in the state. It's got a tremendous amount of value for the education. So when you look at tuition and job prospects, there's a lot of long-term value in there, and it's had a steady and growing student population. We're able to find assets that are close to campus where we know we're going to have defense from new supply because students want to have that walkability lifestyle, and campus can be challenging to access if you don't want to drive. There's reasonable busing system, but being walkable and close really does create that defense for supporting rents. Um,
Yeah.
yeah,
Yeah, having a moat around the business,
yeah,
right?
exactly.
And whether that's, I mean, in this case, location is an advantage or, policy or whatever else. But in this case, definitely location and really serving a certain audience too. So
Hmm.
That makes a lot of sense. Plus, there's infrastructure around to keep not only the teachers but the students too, for things to keep it lively, right?
Exactly. And Washington State University is so important to Washington State that you also are going to have a huge amount of just state support in make sure that those programs are growing, that it's successful. So it's not like we're in a tertiary market that doesn't have a lot of larger dollar support behind it.
So totally, and that makes a lot of sense. So, hey, listen, I'm sure at this point you have a lot on your sights of things that are coming up. Continue to make that 3 year, but we're in the same community. You're learning a ton. Your team is expanding. What is next for you and the team, for you and Tamarack, and for you and whoever else that you're working with, continue to expand the empire?
Yeah, well, there's a couple things. We're still going to be doing our acquisitions and operating our properties like we always do, and getting good returns for our investors. Uh, we're continuing to expand out our online presence. So for any of your audience that wants to learn more, I'm on LinkedIn. You can search for Casey Stratton. We're also at tamarackrei.com. We've got a newsletter you can sign up. So we're really investing in this because we want to be educating people out there who are real estate curious on what are we looking at, what are we thinking at, how do we go about doing what we do, and really investing in that connection with people who are curious about that. But yeah, other than that, we're just going to continue operating and growing.
Awesome. I'd love to sort of close out with two different types of questions here. And the first one, we talked a bit about your research and learnings as you're on your journey already. But you can go back in time, in case you've learned a ton over this last amount of time you've been investing. What would you tell yourself, a nugget or two of wisdom around investing, around real estate, as from now to when you were first starting out?
So I came from an engineering background, and engineers really want to do everything right and perfect. And when I was starting my real estate journey, I was bringing that mentality of I want to understand every single aspect of how to underwrite, how to write contracts, how to do everything. And I think, what do they say? Perfect is the enemy of progress.
Yes.
And hey, get in there early. Uh, don't worry about biting off more, right? And
Hmm.
don't be afraid of trying to get into larger projects sooner. Uh, you gotta get in there and do it and learn to grow.
Got it. So is it could we say that then to, I mean, perfect enemy of progress. Don't let perfect be the enemy of good, or I think it's Patton. It's
Uh,
a good plan executed today is better than a perfect plan never executed, type of thing.
oh, love it. Yes, exactly.
so um so that as a nugget, certainly, because I mean, we were talking about this before we even start recording, is you can de-risk anything, right? And not do anything. And if you consider all the things that we have in life, that is awesome, family, having kids, getting the boyfriend, girlfriend, whatever, getting married, all these things have risk, but they have inherent risk, and you have to look at it, and you have to be, well, I'm willing to accept that and know that I will
Hmm.
figure it out, right?
Yep, yep. Can't sit there and do nothing. There's too much.
Yep.
That's too risky to not invest. To just save, you got inflation. There's always
Yeah,
a risk out there.
great call. Dude, thank you so much for being here. I appreciate you. You already mentioned ways that people can get in touch with you. I'll absolutely make sure that those are in the show notes too.
I
Anything you
appreciate
want to
that.
mention before we close out today?
Man, it's great meeting you. Thanks for having me on here. I hope to be able to connect with some of your audience and you down the road. I don't know if you're going to the conference down
I'm
in
going.
San Diego. Okay, we
Yes,
can meet in
sir.
person down then. Looking forward to that.
Yep. Cool. Thank you, sir. We'll see you soon.
All right, thanks. Bye.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.